Let's now look at property, plant, and equipment. Now note that as property, plant, and equipment are used up, the cost is removed from the balance sheet and transferred to the income statement as depreciation expense. Now, depreciation is an important concept in accrual accounting because if a depreciable asset is immediately expensed upon purchase, profit in that year or period would be too low. And then in later years, profit will be too high. Now, what will be happening is that revenues earned by the asset will not be matched with the corresponding cost of the asset in related periods. The reason is we expensed all the cost of purchasing the asset in one period. Meanwhile, the benefit or the revenues flowing out of the use of this asset will be spanning a number of years equal to the useful life of the asset. So essentially, we're not matching expenses with the related revenues the expenses help to create. So again, this makes depreciation an important concept in accrual accounting. Also note that depreciation expense is a non-cash expense. We do not pay out cash when we recognize depreciation expense. We are only allocating the cost across the useful life or periods we are using the asset. Now, straight line depreciation depreciates an asset equally over its useful life. And the straight line rate is 1 divided by the useful life. So for example, the straight line depreciation rate for an asset with a 10-year life will be 1 over 10 or 10%, implying that every year of the 10-year useful life, depreciation will be 10%. Now, we also have accelerated methods of depreciation. Now, the accelerated depreciation methods, for example, double declining balance method, tends to depreciate the asset by larger amounts in the early years. Now, the primary benefit of accelerated depreciation relates to tax reporting. Now, if you have higher depreciation deductions in the early years of the asset's life, what happens is you are deducting higher amounts in your tax returns. So that reduces taxable income and reduces income taxes to be paid. Now, once we reduce income taxes to be paid, our cash flows increase because we used less cash to pay taxes. Because we used less cash to pay taxes. And the cash saved can be invested to yield additional cash inflows. Now, note that the double declining balance method will use double the straight line rate of depreciation. That implies that for the example I discussed, the double declining balance depreciation rate will be twice or 2 times the 10% straight line rate. So that will be 20%. Let's now discuss property, plant, and equipment turnover, or PPE turnover. Now, the PPE turnover measures the productivity of long-term assets. Recall that property, plant, and equipment represents long-term assets. Now, a higher turnover indicates greater productivity of PP&E. PPE turnover increases with sales volume relative to the dollar amount of PPE on the balance sheet. We will now examine some liability accounts. Accounts payable turnover ratio measures how quickly a company pays its accounts payable. And we calculate this ratio by cost of goods sold divided by average accounts payable. Generally, it is more desirable to delay payment of accounts payable as long as possible without jeopardizing creditor and supplier relationships. So we would find it desirable if the turnover ratio, accounts payable turnover ratio, is as low as possible, subject to not jeopardizing creditor and supplier relationships. Now, the accounts payable days outstanding measures how many days on average it takes a company to pay its accounts payable. And here we divide accounts payable by average daily cost of goods sold. Note that there is a link between accounts payable and cost of goods sold because we generally assume that accounts payable are incurred because of amounts owed to suppliers. Now, current liabilities are obligations that require payment within the coming year or operating cycle, whichever is longer. Generally, current liabilities are settled with existing current assets or operating cash flows. We will now examine bonds payable, which is an example of a long-term liability. And we will begin with bond pricing, bearing in mind that the price of the bond represents the amount received by the bond issuer, which also represents the amount stated on the balance sheet as the bonds payable. Now, bonds are an effective way to borrow large amounts, as the bond issuer pretty much borrows money from any investor who purchases its bonds. Now, there are two important rates in bond pricing. The coupon rate is the rate specified on the face of the bond. It is used to compute the amount of cash interest paid to bondholders, who are pretty much the bond investors. Now, the market rate, or the yield, is the rate of return expected by investors who purchase the bonds. The market rate determines the market price of the bond. It incorporates the current risk-free rate, expectations about the relative riskiness of the borrower, and the rate of inflation. Now, note that in general, there is an inverse relation between the market rate and the bond price in the market. So what this means is that when yields or the market rate for a company's bonds increase, bond price decreases. On the flip side, when yields decline, price of the bond in the market increases. Now, let's analyze an example of cash flows from the issuance of a bond. Assume that investors wish to price a bond with a face amount of 10 million, an annual coupon rate of 6%, and payment of interest is semi-annual. Now, what this means is that for each interest payment, the applicable rate will be 3%. Now, the bond has a maturity of 10 years. What this implies is that after 10 years, the face amount of 10 million will be paid. And that is one unique characteristic of bonds. Bonds pay the face amount at maturity. Now, investors purchasing or investing in this bond issue will receive the following cash flows. Let's start off with the semi-annual payment. These are interest payments. And how would we calculate this? Semi-annual, every 6 months. They would receive 3% of the face amount, 10 million. We always use the face amount to calculate the interest payment. So there will be 20 semi-annual payments over the 10-year period. And then, of course, the principal payment at maturity. Now, let's also look at the repurchase of bonds. Now, in some cases, the company that has issued the bonds, that is the bond issuer, may wish to repurchase or redeem its bonds. For example, yields may decline. And just like what individuals do, individuals like to take advantage of low interest rates by refinancing. A bond issuer may decide to repurchase or redeem its bonds when yields or market rates go down, so that it can also take advantage of the low rates. Now, a gain may result from the repurchase if the repurchase price is lower than the net bonds payable that has been recorded in the books of the company. Again, a gain may result if the repurchase price is lower than the net bonds payable. Lower number compared to that will result in a gain. Now, conversely, the bond issuer will recognize a loss if it repurchases the bonds at a higher amount compared to the liability recorded in its books, which is the net bonds payable. So if this is higher than that, a loss on bond repurchase would occur. Now, note that the gains and losses on the repurchase of bonds are treated as ordinary income. The gain or loss will show up in the income statement.